Eric, we're going back to the married put discussion, talking about buying shares of stock, following our concepts of the full course in the blueprint, buying an in-the-money put 6 to 8 to 10 months out in time to keep a controlled risk to 6, 7, 8% or less. All right. And what Eric wants to know is if I have a position that is now bulletproof, meaning he's generated income using the different income methods in the blueprint, rolling the put, selling calls, doing spreads that carry no extra risk because you own the stock. And now the position has no risk to the downside and still unlimited upside unless he has an income method open. He says, what about keeping a bulletproof position for years? And he gives us an example. So let's take a look at his example very quickly. Sorry about that, folks. Custom spreads, my apologies. He says he bought the UDOW for approximately $70 per share. We'll just use 100 shares in this to keep it simple. And a month ago, following concepts you teach, I added an 80 strike put. Analyze the position, shows a positive position. Should I roll the put to current? Let's see here. So UDOW, it's at 102. I don't know the expiration, but let's follow what we would normally do. Let's say I bought the June 80 put at the current prices. Wow, it's way down there. Sorry about that. The June 80 put at 370. Of course, yeah. So now what does this mean? I own shares of stock at 70. Eric waited for the stock to rise. He bought a 80 put somewhere out in time, but he only paid about 370, 380 for it. No, for 440. I'm sorry, with the bid-ask spread. But that means his cost basis is only $74.40, and he's guaranteed to get $80 back. So he's bulletproof 7.5%. Guaranteed profit no matter what happens next on UDOW to 7.5%. Okay? Now, tracking this position in the portfolio, which we're going to do in a moment using the analysis tool, it shows that I should roll up the current UDOW price or sit back and take profits and start over with a new married put. My premise is that UDOW will continue to rise for several years and I'll continue to hold a position. Just want to be smart about taking profits. Okay. And Eric, you had a follow-up here. Oh, sorry. I know there was there it is. Correction. Bought a 95 put December. Oh, sorry, folks. Let's go back to the real position. December. Excuse me, folks. 97. And I'll use the current price here, which is going to be about 280 at midpoint. Fantastic. So now we've got 72.80 invested in the position, guaranteed to get 97 back. So we're guaranteed a profit of 33.2%. Now let's add this position to the portfolio very quickly. And we'll just call it November 15th. Okay. Let's see. Married put. We're not going to include any transactions. We're just going to use today's date. Not going to simulate that to what was the actual price of UDOW at 70 or what date was when UDOW was actually at 70. And there we go. We've got our position here. We've got our cost basis of 72.80. Right now, you could liquidate for a 44% return. Expiration gain loss. What does this mean? This means if I hold this position all the way to expiration and the stock stays where it is at 102.03 on the UDOW, then that simply means that the time value will decay out of the 97 put. We'll lose the 280 that we have right now. And I know your price was different, Eric. I'm just using the current prices. But that decay would result to a loss of gain, only of 29.23 or 40.2%. That's the time value loss expected over the next 35 days if UDOW stays above 97. Now, earlier I mentioned in the introduction that part of our PowerOptions suite of tools is that you can link to the position analysis view to evaluate rollout opportunities where we do all the math for you. And this is what Eric's asking about. He linked to the position actions. We know we have a profit right now of about 44%. We're going to give up almost 4% if we hold it to December and do nothing with the 280 or time value that's remaining in the put. Now, there's some income methods here. Oh, it doesn't come up. That's interesting. It didn't come up with an income method number 4. Now, here's a neat little bear call credit spread that we could enter, give you a little extra credit of 95 cents, leaving the upside open in this case. That's one of the riskless spread trades. But I expected to see some opportunities for income method number 4. Meaning right now, I know Eric's price was different, but I've got 280 of time value on this out of the money put 35 days out. Eric's question was, can I stay in this for a few years? Can I continue this trade? Should I roll this put out further? And what are the ramifications? Or should I just let it go? Now, this is the analysis. It's talked about in the blueprint when deciding to do different income methods. Why would I roll up the put to a higher strike to lock in more profit? Why would I roll it further out in time to stay in the position? Well, it's because you feel that UDOW has the potential. It's an ultra pro Dow 30 ETF, of course, but it has the potential to grow more than other common stocks or other stock positions that have come up in your research, your analysis, using the search tool and PowerOptions and more. Okay? If you're looking at a position that has a locked-in profit of 40% as the worst-case scenario, right now you could liquidate for 44% after bulletproofing the trade to an extreme amount in this case, but that's fantastic, Eric. I love it. Why would I liquidate this position at all instead of continue it for more gains? Well, if you're seeing out on the market that there's other positions out there that are offering better movement that match the expectation in your SIGA model for a new married put position, that's what we would take. Okay, I would liquidate this and do that. But you said in the first part of your question, you're planning on holding this for years because you think it's going to continue to move up. So my answer to you would be yes. I would look to roll this put up, income method number 4 in the blueprint, roll it up in strike and further out in time. Are you going to add to the overall cost basis of your position? Yes. Are you going to lock in more gains and have a higher guaranteed? Oh, that's the wrong profit and loss. No, that's the right profit and loss chart. I'm sorry. Are you going to lock in more gains in this scenario? Absolutely. Okay. Now, let's take a look. How would I simulate this? Well, we're going to go to view options here in the custom spread tool. Now, I'm going to have to change this. All right, so we're going to add this back in. But what I'm going to actually do is change. Let me clear that out first. Let me change this initial price. Let's say you bought this 97 put when UDOW was only at maybe 99 or 100. So let's say you actually paid $4 for this put. Okay. Why am I illustrating this? You still have a locked-in profit of about 31% from your cost basis. The liquidation value and the future expiration value we're seeing, the 31% is the worst case scenario. The 40% right now is if you liquidated the entire position, stock and put, got that 280 back of the time value that remains, Eric. The worst case scenario is if UDOW drops below 97 before December and you only make 31% with my price of $4. Okay, you only make 31% on the position. Okay, now, what's the pros and cons? We know we've lost money on this put because the stock has moved up. We saw the market value was at 280. So we've lost $1.20, maybe a little bit more depending on what you paid for it. Okay, so let's add that back in. And I'm not going to add the new put yet. Here's the reason why. We're going to simulate selling this put option. We bought it for $4. We sell it for $2.80. We lose $1.20. So now our new cost basis is $71.20 per share if we close this put. Now remember those numbers that we looked at briefly in the portfolio. You've got a 44% liquidation return right now, Eric. At December expiration, the stock is above your 97 put strike price. Your estimated return is around 40%. You're going to lose that 280 of time value that it's remaining right now on your December 97 put. Now I'm taking that off the table. I'm selling to close it, which means I did add to my cost basis on the position. So now I have a gauge that I have UDOW at a cost basis of $71.20 after these put transactions. Now I can go in and start playing with numbers, say, hey, let me go out to January 2026, 427 days, buy a 105 put, buy a 110 put. How does that increase my position? But now that I have effectively know what my new cost basis would be, what I would rather do to be more efficient, rather than picking and choosing, hey, what is the 110 strike? Let me run that comparison. What is the 108 strike? What is that comparison? What is the 105 strike? And do each one individually. Now that I know my cost basis would be $71.20, whatever your cost basis would be, Eric, I'm going to go into the Married Put tab, and I'm going to click Insurance. And this is just a simple tool, but if you have an unrealized gain in your stock that you want to protect and you want to keep trading long term, we just plug in the symbol, plug in our effective cost per share for our example here. This is not Eric's real numbers, but we'll use 71.20. And as I mentioned, I'm going to go out to that January 2026. He said he expected to hold it for a few years. So what can I look at with the various strikes that are available? Well, here are the numbers. The 107 strike put, if we get in at the midpoint price at 18.20, the time value, of course, is 13.23. We have a new cost basis of 89.40, but a locked-in profit of 17.60 or 19.7%. Well, this might not look favorable to you, Eric, because it's lower than the 33% that you had. But this is 427 days out in time, where the worst case scenario is that you would only make 19.7%. You're adding time premium, obviously. We're selling our put for 280, we're buying a new put for around 18.20. But as you see here, why wouldn't I buy the cheaper put? Why wouldn't I go out to the 97 strike and only pay $14? Because then you only have a locked-in profit of 13.8%. You want to continue this trade for years, you can do it this way. Analyze what it would be, what your new cost base would be if you sold to close that put that you have right now. Go to the insurance tool under the married put tab, see what's available. I'm a year and 2 months, my apologies, out in time, guaranteed profit of 19.7%. But what's the trick here? That is the worst case scenario, 427 days out in time, is that you're going to make 19%. What can you do between now and 427 days from now? Still do the other income methods. The stock moves up to 110 or 115 as you're expecting. You could roll the put up again, increase this back to 20, 25, 24% locked in profit, still keep generating income on the position, and still going through the income methods and the Siga model process. And your expectations are it's going to continue to grow. A side question comes in. Tom, I see your 4 or 5 questions. We're going to get to those just in a moment. But what I wanted to add here is someone say, why wouldn't you use a shorter term option? You absolutely can. But remember the concept of options, meaning that options is just like car insurance or home insurance, for your belongings. If you pay month by month, you don't pay a higher price up front. Naturally, I'm paying $100 per month, let's say, for my car insurance, $150 per month for my car insurance. But if they offer a 6-month value, it's not going to be $900. They're going to give me a discount. It's going to be $850. And if I pay for a year out in time, it might only be $1,500, getting 2 months for free. Options prices are essentially the same way. The cost of the 1 year out option is not 12 times the cost of the 1 month out option. It's much less. Now, true, the cost of the 6-month option is not 6 times the cost of the 1 month. It's going to be less. But if we went 6 months out in time, let's say to July or August, I forgot to check if UDOW had any strikes in August. It did not. So let's go to July. June. There we go. Okay. So here, going out to the June 107, what did we see? Well, now we have a 25.8% locked-in profit because we're only paying $13.85 for 217 days. For 427 days, for the January 2026 107 put, was I paying $26, $27? No, we were paying $18.85. Okay, so even though that only locks in 19% of profit, I'm paying less per day for the insurance going out to January 2026 at this 107 strike than I am paying the, all right, it's not technically 6 months, it's closer to 7 months out in time, but at the same time, we're paying $13.85. Still paying close to 65, 70% of what we'd pay for the 427 day out option, almost twice as much out in time. But that's the trade-off. Could you buy the June, Eric? And then as the stock continues to move, still do income methods shorter term? Yes, the stock moves up. Could you still roll the June 107 up and strike to the 110, 115 for June, or then roll out to the 110 or 115 for January 2026? Absolutely. My approach here for why I would consider buying the January 2026 or possibly even further out in time is because the point of your question was, if I have a bulletproof position and my expectation is the underlying is going to continue to move up and I want to hold it for years, the best price is farther out in time. You could even go to the January 2027 or January 2027, December 2028. You could go further out if you wanted to. Okay? You're going to have less locked in profit at first, but you're paying less per day going further out in time. So again, process in this situation, analyze, oh, sorry about that, folks. Analyze what your cost basis would be. This is the January one, but your original cost basis, analyze what it would be as you're tracking it in the portfolio. If you don't see the rollout opportunities, link to the custom spread tool, simulate closing that December option that you have, get your new cost basis. In our example, it was 71.20. Take that price, go to the position insurance tool, just put in your stock symbol, put in your cost basis per share, and then toggle between the different months so you can see right away, what am I giving up for this extra cost? How much time am I gaining? Is it worth it to pay cheaper and just go 6 months out in time? Or is it better to go farther out in time initially, still be able to do the income methods for the next 427 days, still having a 20% guaranteed profit as well? Or third idea, just like we talk about with a covered call management. Hey, do I take the max return now? Do I roll the covered call that's in the money because I expect more higher upside? Or do I just liquidate now and take the 44% profit and start a new married put? Well, no. That does, liquidating now and starting the new married put on UDOW, Eric, does give you the 280 of time value back that we saw on your December 97 put. But you're already planning to stay in it. Why do that extra process of closing your stock, closing the put, rebuying the stock, rebuying the new put? Just roll the put. You're planning on staying in anyway. Just do one transaction. Keep it simple. In other words, that's what we look for.